Hey, if you've been interested in investing in syndications but don't know the right questions to ask, and you want to learn from someone who understands from the other side of the table, you do not want to miss today's conversation with Evan Polaski. Now, Evan has worked with four different syndicators and has almost 20 years of experience in real estate, both in retail, multifamily, and so much more. You're going to learn how to vet operators and how to vet deals. Check out this conversation right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Evan Polaski has 18 years of experience in commercial real estate. He has experience in both retail and multifamily, not to mention 15 years of direct real estate investments in single family, small multifamily, burrs, and flips. And on top of that, he's been a limited partner in syndication deals for over 5 years. Let's welcome to the show, Evan Pulaski.
Thanks for having me, John. Glad to be here.
Yeah, absolutely. Evan, it's great to have you on. On top of the investing experience that I mentioned in your bio, you are now running investor relations over at Blackgate Partners. But why don't you take a minute or two and give us a little bit more context on your background?
Yeah. So, as I have said in multiple interviews over my years in the real estate world, I've just loved real estate since I was a little kid. I remember growing up for a period of my childhood. I was in suburban Atlanta watching the Publix anchored and Home Depot anchored shopping center get built, a half mile outside the subdivision I was in. But whether it be touring like construction homes with my wife, now wife, when we were dating 20 some years ago. Just always loved everything about real estate. Obviously, as a kid, not knowing the finance side of it, just being in awe of it. And the construction process specifically tends to draw me in. So, fast forward a long time from when I was 6, uh, I had a friend, actually a coworker that was going through the real estate program through University of Cincinnati's like business school, and happened to glance at his homework that he was doing while we were at work, restaurant work, some downtime, and just like, oh, numbers, real estate, kind of like that's my jam. So, uh, graduated from UC with a business degree focusing on finance and real estate. Got my first job out of college for a retail operator in the investor relations field specifically, because it was a large grocery anchored shopping center, now publicly traded REIT. But I was the analyst putting together decks and investor bios for the capital raising team. And, kind of had some journeys through the financial crisis and stuff and coming out of that, but ultimately landed back in real estate and have spent basically my entire professional career plus some college in there. Even when I wasn't professionally working in real estate, I'd already owned some single family rentals, understood the larger investment structuring, and was starting to pull some strings and pieces together to try to be a syndicator. Hit some roadblocks that I should have worked harder to get to overcome, but still happy with where I landed.
Evan, appreciate you sharing that background, right? I mean, I think about my kids, man, my oldest kid in particular, when he was really little, like toddler, he was so fascinated with the construction trucks. I mean, he knew the name of all of them.
Yeah,
And I didn't, like, I knew half of them, right? But he had books and that's all he wanted to read, right? So I'm picturing like that level of fascination of you as a child as well. And just knowing the cherry pickers and all the little trucks that you don't see all the time as well,
yeah,
just loving construction, and just how that fueled you, as an adult. Go ahead.
yeah. And I was gonna say, to me, There was probably some of that as, like, a little kid. I don't actually remember that part. The more telling piece is when I'd come home from even in high school, I would come home and watch Home Time and, like, I like the building side. I still like that. So I like, kind of the carpentry side of putting together things, building the planting beds in my backyard, but into the bigger, like, the high rises in Manhattan. Not that I'm out there watching those get built, but anything bigger scale too. Um, it's it's really been just kind of that whole picture. And then all of a sudden, I do remember being, I think, 8 years old and be like, that's the grocery store like we go to now. Like, I don't totally remember the pavers coming out and laying the parking lot. But yeah, it's just been something that's always fascinated me in kind of taking, and admittedly, like, the environmentalist in me doesn't really like development per se, especially like the sprawling suburban stuff. Uh, but still, that taking nothing and having something, you know, in the physical world come arise from it is always been fascinating from, young ages.
Yeah, that creation process, man, I love it. You're the kid watching This Old House, right? On Sunday and
The
Saturday morning.
with,
Oh,
why am I blank on his name? But yes, that's another one. There's a whole lineup on,
Vila.
Avila, and there's a whole lineup that came in on after school hours on PBS. That is literally what I watched almost every day after school.
I love it. I love it. What a great foundation. So fast forward, right? You have your buddy, you're watching it, just checking out his homework. Realize, man, that passion for real estate just re-sparked and reignited right then and there.
Mm.
And that's what you got to focus on, right? Helping these
Yeah.
different companies build out. You got into investor relations. And you mentioned a couple of things, right? Just as your journey, you started investing a little bit and wanted to kind of build the path to be a syndicator, which didn't 100% work out exactly, but you stayed in this space working as a general partner, working on the partnership team and doing this for, sounds like the last, like, what, 10, 15 years or so, working in some
Mhm.
different capacity in real estate. Let's talk about what you do today, and then we'll kind of rewind the clock back. So, what do you do exactly?
Yeah, so I am my official title is the Director of Capital Raising for Blackgate Partners. Uh, mm, but ultimately, it's the investor relations role that I've played in multiple with multiple GPs. Um, so it's helping, you know, structure the deals, review the legal documents, but the biggest play is clearly the investor relations side, both new investor side and, you know, maintaining those relationships, addressing questions, et cetera, for the existing investors.
Yeah, the director of capital raising, mostly investor relations, combination of answering questions, but just making sure that you understand what investors need to get comfortable with the deal.
Yeah.
The market has shifted a lot over the last,
Oh, yeah.
5 years, right? I mean, 5 years ago, especially once COVID kind of settled down and people realized, like, oh man, there's actually great value and rents started shooting up. Like, it felt like there was plenty of capital flowing around. You just had to have a decent deal to attract that
Mhm.
capital. And it feels like it's kind of shifted 180 now, where you have a lot more conservatism as far as the deals that investors are looking to invest in, a lot more, call it scrutiny or diligence that's being placed on the analysis process. So, not as easy today as maybe it was 5 or so years ago. From your perspective, talk about kind of how you've seen that shift. What are some of the different changes and challenges that you face today?
Yeah, and to dial back a little bit, I remember talking, I wanna say it was 2017, so when I was CrossFit gym owner was my day-to-day profession, um, but I was talking with a broker as I was starting to look to pull together a syndication, and this was a local Cincinnati broker who had some kind of, I'll call them smaller deals. I, of course, wanted to do the 100-unit deals, um, but he made the comment of like, oh, just capital and deals never align. When capital arises, you're short on deals. And alternatively, when capital is when deals are plentiful, I'm thinking back to the financial crisis, capital is hard to find. And that's kind of where we feel today. And it never just sits in equilibrium where you have good, solid deals and relatively easy capital to access. It's either one extreme, as we saw in 21, 22, capital was pumping into the market, and as we see, turns out deals didn't pan out very well because a lot of syndicators had more capital than had deals, so they just started backfilling any deal they could find. Uh, Alternatively, I'm going to rewind. Current day also feels a lot like the financial crisis, which is actually when I was laid off the first time about 2 years into my career, because I was on a capital raising team. Money dried up real fast. We were raising institutional money, got our early commitments from repeat investors, and then hit a brick wall. And, this was not a small brick wall or a weakly built brick wall. This was, the fortress around Fort Knox level of brick wall, where it's like we couldn't get people on the phone. And that's when people actually answered phones back in 2009. So it it's starting to feel a little bit more like that, which you hear a lot of people in the industry talking like, this is where deals are made. I generally agree with that. There are still a lot of deals that feel too thin, um, just given where interest rates are and stuff. But you know, it is a dynamic. It's a major shift. I recall being in the industry in 21, even into kind of mid 2020, as that March drop, every investor went risk off for about a month and a half, and then all of a sudden things just started, you know, stock values started flying again. Interest rates were cut to basically zero, and everything was just looked great. So starting there, it became, you know, admittedly, I was a bit of an order taker. Like there was no sales response. Like there was no sales in my job. There's no overcoming objections because if you were on a call with me and you had an objection, I'd be like, well, here's how we do it. Period. Invest or don't invest because I have 10 more calls lined up right behind you and I'm going to have more money than I need. And, that kind of ran for a solid year and a half, 2 years. Um, Now it is a lot more. I don't like the term dragging people over the finish line, but there is a little bit of that. It's a lot more re-ups from existing investors that continue to trust the process, that have hopefully been with you through some of those good times and saw some of that, the real value in there. I do think there are a lot of investors that got in at that peak. First time LPs jumping into a syndication in 21, 22, um, and that, you know, bringing the analogy of the CrossFit gym, like every syndication is different, but if you were burned in one, anything with that label has now been tainted for you, probably maybe forever. So it is finding a bit of those new roster of investors, while also obviously trying to source out those ones who might be realizing or maybe not realize yet some losses in their portfolio, but still see the overall value with with the deals. And while real estate can be very safe, it is, and I thoroughly believe that. As we're seeing, a lot of the deals that are going south are structurally faulted, or in hindsight, like they were just. It's not the real estate typically. It's how the capital is structured, floating rate loan, short term debt, particularly in the multifamily world, but others as well. Um, that that's the root cause of it, and you can't undo it, but you can learn from it. But I talk to people all the time, like if you want the safest real estate, you're doing it for diversification, not for some huge IRR, because a core deal, 50% LTV in a great market, you know, no deferred maintenance, no real value add, all of which add risk. Just take all the risk out and matching bond yields, maybe a little better. You get a little bit of tax advantage, but like you're not projecting a 20 IRR on a new construction deal. The developer might, but if you're buying in secondhand from the developer, you're getting your 5 or 6% cash flow and maybe a little bit of appreciation, 2-3% year over year, depending on market and other conditions that you can feel confident in. And anything above that would be what I consider aggressive assumptions for that type of deal.
Yeah, Evan.
Was that the long-winded answer to your short question?
No, no, I think it's great. First of all, you talked about capital never quite perfectly aligns with deals, right? And I think it's
Yeah.
just important to understand there's always this pendulum on money that's available to invest and the deals that are out there that are ripe for investing. Really
Mhm.
great deals, the reason they're really great is because there's less demand for them. It's just a natural pendulum where
Yeah.
it kind of has to kind of balance each other. So in times where you can find great deals, part of the reason you can find the great deals, there's not a whole lot of capital chasing those deals. The flip of that is also true. In times where there's a lot of capital available, there aren't really great deals. That doesn't mean you can't buy properties that pencil or make sense, but obviously you need the economics and the market and the business plan to stay consistent as well. So that's the challenge. And I think too
Mhm.
often people look at investing as this like monolithic approach of either it's good or it's bad or this is great or this is not. It's not. It comes down to the business plan like anything else. And
Yeah.
whether it be multifamily or any other asset class, you have to understand what are the key factors and then what can impact those key factors. If you're not doing that and you're just blindly investing because your buddy made a bunch of money on this multifamily deal a couple of years ago, then yeah, you're probably going to get burned. But if you're listening
Mhm.
to our conversation right now, then you're savvy enough to do some education and to learn and to ask better questions. So I pose it back to you because you've been through a couple different cycles. You've worked for different general partnership teams. You've invested as a limited partner. What are some of the key lessons you learned in investing principles that you utilize today?
Yeah. So it is, there's kind of a few factors. So the one I've always stood by is I almost always invest with people that are older than me. Uh, because I admit I'm 42 years old. I started my career, I took a long way through college, but I started my professional career out of college in 2007. Um, got laid off in 2009 because the assumptions made in 2006 on a big, you know, portfolio transaction turned out to be pretty aggressive in these retail deals, and all multiple factors intertwined. But ultimately, it's like, yeah, for me as an employee of these GPs, um, it's just like the LPs. Rents need to get paid for money to flow into the company and to the investors. Based on how fees and other things are structured. But if rents aren't getting paid, nobody's getting paid, including the investors and myself included. So got downsized. First layoff of that company ever, and it was about I think 10%. It was only a 200-person company, but 10, maybe it was 10 to 5%, 10 to 20 people got laid off in the first day. From what I understood from friends, like founders, COO, like the C-suite of this, moderately sized real estate company were in tears in front of everybody, being like, "We had to let people go." So it wasn't an easy decision for them. Um, but the but because of those lessons, I look back and I'm like, yeah, I understand a 25-year-old might be hungry and ready to go and watched a lot of podcasts and hired the right mentor and all this stuff. I'm like, but you don't know. And I think we're seeing some of that now play out in various spaces, but I think multifamilies kind of hit the hardest because it seems to be the easiest entry level for people to buy a handful of single families, then raise a couple hundred grand to buy an 8 unit, raise a few $100,000 more to buy the 20 unit kind of thing. And even though renting is still cheaper than um, than home ownership in today's market, it's like your renters also earn less than the typical homeowner, and they can leave. There's not just a guaranteed supply for all apartments everywhere, and then the supply demand dynamics, various factors that you start to internalize when you've lived through a downturn. Um, so that's a big one. I've gotten a lot more diligent on trying to understand where true alignment comes. Like a GP and an LP, admittedly, are never going to be 100% aligned. Um, if there's fees involved, period. I don't care whether it's like a 0.5 point acquisition fee or an 8 point acquisition fee. Like there's a certain level of misalignment right there immediately. If you're not going in as a true JV, just money for money, equal partner kind of thing going into the deal, then I think there's always gonna be a little bit of misalignment. Um, but I do see the value in syndications and being an LP, especially if you're, the typical LP, a high earner. You know, this is going to be far more lucrative focusing on your career than trying to become a full-time real estate investor. Uh, but having the diversification, the income, all the things that real estate can play in one's portfolio. But with that, I have become more focused, admittedly, on specifically the acquisition fee. Because you see some syndicates out there who are charging I've even heard rumors of like 5-6% on smaller deals. But I'm like, that that is a pure A, it hurts the IRR the most because it's on the front end and it's just an extra cost. B, oftentimes I see groups that their acquisition fee out earns their co-investment. So even if they're saying, hey, I'm putting $1 million into this deal, if you're buying a $50 million deal on a 4% acquisition fee, you just earned $2 million. Now, I'm on the inside. I know that is not a like out my pocket, right back into my pocket. There's costs of running businesses. There are often multiple people involved that are splitting that acquisition fee. Um, you know, I'm not opposed to acquisition fees, but you see it more. To me, it's a telling sign the higher that acquisition fee gets as a percentage. And I have really started looking at it as like, what are sponsors in the deal net? Um, when you take acquisition or co-investment less acquisition fee, are they still in equity? Are they not? And I'm not saying that earning out your equity is 100% bad thing. It's a factor within a lot of different factors, or one of many factors. But if you're looking for best alignment, if they charge an acquisition fee and they still net equity into the deal and a significant amount of equity, all the better. Um,
And
other
let me let
fees.
me let me
Oh
cut
yeah,
you out
please.
real quick. So you hit three kind of things you look for, right? First of all, you talk about just the age, and I'm gonna add experience as well, right? But age and experience in years doing this, because some people, you can have all the training in the world, you can have all the coaching in the world, you can have the best intentions, but you just kind of have to see stuff. You have to go through it. You have to have
Yeah.
a long track record, and you yourself are saying, "Hey, I want to see somebody who has more experience than me, older than me, but really groups and partners who have a long story track record, who understand how to navigate the landscape," right? The second thing you talked about was really well, I can't read my handwriting here.
I was primarily hitting on acquisition fees, but it is kind
Well,
of
I got that one. That was
just that
there was
alignment,
something you
the
said in
alignment
between.
over just the general alignment, like
Yeah,
how first I hit that, like, I don't think there's ever perfect alignment between an LP and a GP.
yeah,
Um, and specifically as soon as you put fees in, but even just if it's a pure carry interest play. Um, but it's a multitude of factors that I look at that
yeah,
we probably don't have time to like dive into.
right.
But within that alignment, which is a big one,
Yeah,
I will look at a lot of factors. And acquisition fee, I would say, plays a disproportionate has a disproportionate weight within that overall. It won't totally break a deal. It's not like a all or nothing, but it has a little bit heavier play for fact because it can very much incentivize sponsors to transact. And again, this is
definitely.
my personal perception.
Yep.
There are some sponsors who have had deals that aren't going well. There are many sponsors that have deals that aren't going well, but I think there are some still out there that are still aggressively acquiring deals and trying to pull them together simply to make the acquisition fee to help funnel the money that, and again, this is not a, I don't want to drop the word Ponzi scheme, but like there's nothing illegal about this. This is money they earn from one deal that they are legally allowed to redeploy to help prop up another deal in their portfolio. It's not taking investor money to prop up a different deal. It is their money to do what they want with. Um, and part of me is like, it's kind of just doubling down that house of cards. And
Yeah.
again, there's only a couple sponsors that I'm aware of that is my sentiment, and they might say otherwise, but I'm not going to listen by name anyways. Um, it's just it gives that perception that then a lot of other things have to help overcome that perception for me to feel more confident. Um, and part of it is because I view real estate as a safe play, but it's only safe when structured correctly and not just the debt and equity ratios and the debt side. It's what are you as a GP incentivized to do, and where are your real motivations there?
Yeah.
Um, which does get down to you got to vet the jockey and you got to vet the horse. And I don't think you can't vet and find the great jockeys and then just assume they're only going to ride good horses, because they clearly don't. So it is equal parts in my mind.
Yeah, Evan, I'll recap that a second time better than I did the first time, right? But you talked about the age, right? So really the age of the operator, their experience, just understanding, you know, their knowledge and just what they've seen. And then you talk about the alignment, right? The alignment of interest between the operator and the limited partner. There's never going to be a 100% perfect alignment. Even in the scenario where everything gets split 50-50, it's still not a perfect alignment because as the general partner, if you're the one doing all the work and responsible, you're actually taking on more. So it's really hard to be the one putting in the sweat equity and being in charge of the returns unless you all are truly JV partners. Everyone's involved in a deal. But obviously, we're not talking about a syndication in that
Yeah.
space. So the things that you're paying attention to, there are a number of different factors, but one of the easiest is the acquisition fee. Not to say that you can't charge an acquisition fee, but if that amount like supersedes like what they're going to put into the deal, or is just an outsized number, 5% of the deal, 4%, 6%, whatever it is, that would be a bit of a you didn't say this, but I'm gonna say a red flag, right? That's something that you probably want to explore further. And what we're getting at is this really a good deal that the operator believes in? Or is this a deal where the operator can make some money and they hope it works out, but maybe the business plan and their passion behind the project doesn't match, what they can make? And it's tough. I think as an LP investor, it's tough, and you've worked for 4 different syndicators, so you have a little bit of a behind the curtains peek. I like to think as a syndicator myself, just to, put it be 100% transparent, we have not done a lot of deals over the last few years, and it's for what we've talked about, and it's frustrating. I can tell you, it's very, very frustrating to the point where, we've looked at deals and we said, "Am I being too conservative? Like, maybe we should just
Mhm.
go out there and, do this." And we always come back to we're focused on the long haul and we want to do good deals, want to do good business. But it's gotten to a point or had gotten to a point where we had to start looking and say, all right, we probably gonna need some other ways to make money then because there's not enough cash flow coming into the business where we couldn't grow, we couldn't hire people, we couldn't do those kind of things. And I watched so many other people grow and just closed and add to
Mhm.
their portfolio. And it's a case of um, whether it be the grass is greener or whatever you want to call it, like you start to have some of those doubts. And I feel like we've been, I don't want to say vindicated, right? But I feel like our analysis of the deals in the market and our patience has proven to be accurate. With that said, I'm not knocking anyone who was confident because we all just have a different way of looking at risk and deals and all of that, right?
Mhm.
So from your standpoint though, working across these different operators, if you were talking to an LP investor with the knowledge that you have now and they're looking at a deal, um how do you approach that? I mean, are you in salesman mode and it's just sell the deal no matter what? Or are you trying to understand their goals and trying to align whether or not this deal matches? Like how do you approach that?
Yeah. I personally take the latter approach. And admittedly, I think anybody you have on this podcast that is in the capital raising world in any way, if they don't say that, like, I guess good for them, for
Right,
being
right.
brutally honest. But yeah, like that's kind of like saying the talking point from years ago was, well, we have conservative underwriting. And it's like, but what does that mean? Like, there's no metric of what is conservative because it all happens in hindsight. Um, but anyways, I I take that approach, and I say this true because like I have had investors who I won't say I ever oversold. In fact, I felt like I was very honest with them. That thankfully I was with a GP that was able to buy them out, like because something I had said, uh, just they there's one case where I was, like, kind of using historic averages. Like, historically, this is what has been achieved. We don't know on this deal because we haven't closed it yet. It had to do with pass-through losses and depreciation, etcetera, in terms of cost sake. And that number came back at half of what our long-term or, like, our historic average was, and that was a big deal for this investor. And it was just like, I told you I can't guarantee anything, but here's what the historic average is. Invest or don't invest. Kind of, if we were in that era of kind of like, don't care, we'll find it somewhere else. Um, and they chose to invest, and it was an issue when that first K1 came out. They were like, this is not what I expected, da, 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 and we bought them out. And I say that because I've worked with people who are more salesy and they kind of come from that sales background, maybe a background that's more transactional. I'm selling a product, and therefore, like, as soon as you write me a check and I deliver that product, everything else is to be, is done. Um, and that's not what this game is about. This is like when you're raising capital, as you well know, these are 3-year typically on the short end. A lot of those 3-year deals are turning into 6 and 7 year deals, and you got to live with those people for the next 6 to 7 years. And one of the great things that I learned from one of our mutual friends, Joe Fairless, is like, it's all about expectation setting. Like, I have met people who have invested in other syndications. They were in it for 3 years. And this is a pretty well known company. Um, and, or at least, within circles, it's well known. And he's like, no, I made it. What do you say? I made a 20% return on investment. And he's like thrilled about this. This guy's some guy who does kind of like sells housing products as his day job and then is a passive investor. It's like, no, no, like we held it 3 years. I made a 20% return on my investment. And that's how he's phrasing it. It's like, do you mean like you invest 100K and over 3 years in total, you made $120,000? He's like, yeah, it's great. And I'm like, I didn't say this to him. I'm thinking like, that is a very subpar return because this was a, 2018 to 2021 deal or something along those lines. I mean, it was when everybody else was hitting 25% IRRs kind of thing. But his expectations were set with that sponsor group, and they met them and they communicated clearly, and he's like happy as could be. And I'm just like, again, it's not about the big number. It's about managing, meeting, and then slightly exceeding those expectations. And I find a lot of people feel the same way when I'm on public forums today, uh, in this kind of space. It's, yeah, people are upset that they might be losing money. If I point at somebody else, there's three fingers pointing back at me. Like, I still chose to write a check if I'm going to lose money in that syndication. Um, but it is, how was it communicated? How were those expectations set and then updated over time as things do change, uh, is a very large factor. And back to the investor uh, base and going into sales mode or otherwise, it's like, if I don't consider myself a salesman. I'm like, I've been here, I've done that. Like, yeah, here's some risks involved with this. Here's how I think we mitigate those. Here's how I think we align with you as a GP, um, to do that. And but at the end of the day, it's kind of you can invest or you cannot invest, but I want to sleep at night. And again, I think there are a lot of good sponsors out there. I think there are a lot of good people who at one point maybe had a little too much confidence because I hit some early home runs
Yeah.
in various types of ways that they kind of become a product of their own successes. And now that we're in correction mode, they realize, like, oh, maybe those successes really didn't have much to do with me or us.
Yeah.
We're average. Uh, I was at the right place at the right time. So, you know,
Yeah.
it is hard. It's hard as an LP to like filter through all that. Um,
Evan, you said a couple things there. I mean, one, if I summarize it, it's recognizing that as an investor relations person, your job isn't to sell, it's really to educate on the potential risk, the upside, what we've seen historically, but it's to manage expectations. And you hit on that, right? It's manage the expectations, meet the expectations, and do your best to exceed those expectations. And even in that case where, you mentioned someone got a 20% return over 3 years, that's like a 6.7% annualized return, right? You probably could get that at that time, putting it into a savings account or something, right? Um, so to get that on a real estate syndication deal is like, it's small, right? It's fractional. It's not worth the risk to most of us. But for
mhm.
that investor, because their expectations were managed, they met those expectations, that person was fine. And I think too often we kind of can get in our own heads. I have coaching clients of mine who ask, hey, well, how should I structure this deal or what kind of return should I offer? I'm like, you're asking the question the wrong way. Really it comes down to what are your investors looking for? And if you're not talking to them, you're not going to know. Now, certainly there's a benchmark that most people use. So certainly you can start there. And I've got an investor, a family friend of ours, they had money sitting in a savings account, 6 figures worth of money sitting in a savings account for a few years, and it was really for kind of college savings. But like, keep in mind the last few years, right, where interest rates are crazy low. So they're getting like two nickels in interest on 6 figures. And I'm like, wait, what? You just have this money sitting there like, yeah, we don't really know what to do with it. I'm like, okay, well, I'm not telling you to invest with me, but here's more about what our deals do and
I think broadening its horizons
broaden it
to some
because they don't
options.
know. A lot of
Yeah.
people, this is the thing that your average person does not know that they can invest in real estate passively. They know they can go flip a house. They know
Yep.
they can go buy a rental, right? They know they can they can become a real estate agent.
Mhm.
Many of them are not. The vast majority have no clue that they can invest passively in these deals. So one is just the awareness that this vehicle exists. Then it's helping them understand the potential risk of the vehicle and then helping them understand how you are navigating or mitigating those risks, right? So that's a conversation to have. But coming back to what you said, and the thing I love is this is true for all sales, right? I mean, you're always going to have those, I don't call them slimy, but you're always going to have those people who are aggressive and only focus on the transaction. That's every industry. But the best salespeople that I've ever met, they focus on finding the right fit and solution for the individual. And yes, there may be other options out there. It's not my job to tell you everything that's out there, but it's to understand, hey, what's your problem? What are you looking for? Do I have a solution for you? And here's what you need to know about that solution to make an informed decision. Because to your point, if that investor that you referenced earlier was looking for the tax benefits, and they were investing primarily because they wanted that K1 loss. They wanted that, bonus depreciation, to kick in, then that's something that they were honed in on. And for whatever reason, if that didn't happen, now you've got someone upset because they feel like either they've been misled or they would have made a different decision. And none of us really want that. And in your situation, you mentioned you were able to buy that investor out. A lot of times we can't do that, like your typical syndicator is not in a position to cash out an investor just because they didn't like the K1, right? I mean,
Yeah.
it's different if like a life event happened, but and I think that just goes into character and how you want to operate as a syndicator because I imagine 50% or more probably would have said, listen, we did everything right. We conveyed everything we could. Like this is not a reason to exit this deal because you expected, a higher write-off number. And quite frankly, there's not much you could do about it at this point anyway. So, but I
Yeah.
think it just goes to show, like, again, the dynamic in nature of that LP kind of GP relationship.
Yeah. And it is tough because I can see where, like you said, this was not I'm going to call them a major investor. It wasn't a small investor. If I recall correctly, invested $75,000. So that's not a chunk of money that most people just have like, cool, write them a check. It's like not only I, the syndicator, if I were the person actually writing the check in this scenario, buy like this deal enough to invest another $75,000, but I also have it. It's right here. I can write a check tomorrow, and he's out. I'm in for more. Life is set. Um, and yeah, and especially when you get into bigger checks, I think even some of the bigger, more successful syndicators, as I've talked with, friends who, have 5 to $10 million net worths, and there's like, yeah, but like we don't keep $100,000 liquid, let alone $250,000. I'm like, but you have like $8, $9 million net worth. You don't keep like a little pool somewhere that you can kind of tap into. And they're like, not really, because as soon as it's there, then I'm antsy to get it into something that's earning me more than a high yield savings account. Um, so, it's all just, all interplays. And I stressing out about it because I'm like, shoot, what did I say to him? Like, because it happened months later because it got into the deal and then it wasn't until the K-1s were issued. Um, and like, I looked back, I'm like, no, my email clearly said historic averages.
Yeah.
And then like the Excel spreadsheet that I sent him that broke it all down said historic averages. Like there was a lot of just, we can't guarantee this. Just like you can't, everything is a projection. It's not even your 8% pref or 7% pref. That's not a guaranteed return. That just means you're going to get it before I get anything.
Yeah.
And so it is an interesting dynamic. But to your point of kind of jumping back to that, the kind of growth and alignment and equilibrium of capital and deals, you know, one thing I've thought of a lot, just given my role, is, syndicators, especially if they are wanting, whether they want to grow or not, like whether they're happy, just like I do one deal a year on average, it's fine. I live off of it. I make enough that like I'm comfortable. I don't need a Ferrari and a new, house and a, you know, expensive European vacations or anything. Like I'm happy just being middle class, but and leading a normal lifestyle, doing what I want to do. It's it comes down to at some point you can't do everything, as you well know, and you have to hire people. And those people, whether you want to or not, whether it's a goal of you to run a 200-person organization, but those people, they want opportunities to grow. And if you, the syndicator, the head of the syndication group, the GP, aren't building your own portfolio, you have nothing to offer that accountant who wants to move into more of a managerial type role, become a controller and oversee a couple property accountants, or the investor relations guy who's wanting bigger bonuses, or, the acquisitions guy the same way. It's your, you know, as bad as it sounds, it's kind of like if you have anybody on your team down to you know, the VA assistant who's going from, let's say you're on the $2.50 out of the Philippines route. I've never hired a VA personally, but let's say that's it. And they want to bump to 350. Like, hopefully that's not too much that you can't afford it. But at the same point, it's like, I have to grow to get that just to offer this person who I value more. Um, so sometimes I do, and there's no right, like your clients are like, what's the right balance? Well, you want to give your LPs as much as you can because the better you do for them, the more likely they're going to keep sustaining your growth. But if you're always giving them 100%, you got nothing left and you're doing it for free. So there's no right balance. Um, and there's no real wrong balance, I think. And this is what I see a lot as I talk with people today who are in deals that are not going necessarily great. It's not so much the syndicator can't get paid, the syndicator shouldn't make money, et cetera, et cetera. It's everybody has their own perception as to what's kind of egregious,
Yeah.
and I take the approach of like, if I'm going to co-invest $100,000 into a deal, but make 2 million the day it closes, and then I split that 50-50 with a partner. So I only make $1 million on my $100,000 co-invest. It's kind of like, to me, that feels egregious.
Yeah.
If your 100 is going to turn into 200, 250, so maybe there's a 500K acquisition fee and they get split like, you know, all right, we're not talking you living high on the hog and peacing out day one, um, and just leaving town forever. Uh, so I think that's where a lot of that's where I see it. That's when I'm talking to investors today. Like, that's where they are getting more educated. Those that aren't just burned
Yeah.
and said, "Guess what? I'm out." Uh, they're starting to take a deeper dive into that. They're starting to look at those track record numbers that,
Yeah.
great, 25% on 15 deals on average. Like, that's a great track record. Oh, but the last deal you sold was in 2022.
Yeah.
Let me start seeing some of those current T12s. And what's your budget, like your
Exactly.
current budget and your pro forma, your original underwriting to where you are today. And I
And
think,
Evan, if I could jump in, I mean, you,
yeah,
you said
at least,
there are a couple things that stand out. I mean, just on the operator themselves and the co-invest. You're right. You want to make sure that it makes sense, right? That they actually have some skin in the game if they're doing the co-invest and it's not egregious. And it really just comes down to character, right? Like
mhm,
that alignment of interest, it's always going to be a little bit off, but like you can kind of get a sense of, does this person believe in the deal? Are they demonstrating kind of good character, or is there something here that feels a little bit off? And that's something you're always going to have to look into. You talk about the track record, and I think it's great because I was having a conversation with another operator and realized that we had some phenomenal wins, but we weren't highlighting them in the right capacity. So you talk about like IRR growth and results. Well, one of the things they said was how much of that came from NOI growth, right? So drive the actual net operating income or the performance of the property versus just cap rate, compression. Because there's a big difference in buying a property and just having the market decide more people are interested in your property, so they're going to pay a higher price for it versus you actually executing the business plan and demonstrating that NOI growth. We had a property where we actually grew the NOI by 100%. That was not
mhm,
in our projections, by the way,
yeah,
but we did. We grew the NOI by 100%. Very, very different, because we could control that NOI to a greater extent. That reflects on us as operators more so than the market just deciding this is a hot area. I don't want to say got lucky, but we picked a great location. And now more and more people are willing to pay a premium to invest in that same property or that same location. So those are the kind of things, if you're an LP investor, you want kind of that advanced level of things to look at. Those are the kind of things I would be uncovering, right? If you're looking at a deal, hey, how much did you actually grow the NOI? How much did you grow rents? What was the operating performance? Not just what you sold it for. We could sell it because, again, you sell it in 2022, 2023. Sure, you probably got a great number for it, but we can't control, the exit cap rate as much. What we
yeah,
can control to a little bit of a, greater extent is the NOI growth and the implementation and execution of our business plan. So we always kind of tell investors, hey, just don't just look at the total return numbers. Those are great, but also see how we got to those returns and how much of that we can control as operators. Go ahead.
yeah. And I would say a couple things. One anecdote was, I was talking with an LP, different syndication, and they just sold. He's like, "We got 30% net IRR out of this deal." And he's like, "I'm not investing with them ever again." I said, because, to your point, he was watching their P&Ls and comparing it to their original underwriting. He's like, they were 30% below their projected NOI at sale. They got lucky, right market, right time, bought early, sold high, like, great. I'm happy to make money, but like, not the kind of people I want to keep investing with, because they're not proving themselves to be able to be a sustainable business model. They're speculating, just hoping for the best. Um, Along those lines, in my early career, I was raising institutional money, or worked on a team that was raising institutional money. That is one big advantage I saw working with institutional investors is they are longtime investors. So to them, it's not a what have you done for me today per se. They might reinvest with a group that lost 10% on their last fund or 20%. But that if that 20% is still better than all those other similar vintage deals, so if they put a bunch of money into work in 2004 and by 2007, half of them went to nothing, because of leverage and just all got wiped out and went into foreclosure, let's say, and then there's five over here that only lost 20%, where everything else is somewhere between a total loss and a 20% loss. Those are still the best players, you know, in terms of what's our sample size and how are we doing. So it's not a like, oh, I'm going to compare syndicator A to syndicator B and what's this syndicator's track record versus that syndicator's track record. Because, for me, when I'm looking at track record, it's like I value, and this goes back to my earlier comment, like just this experience. I will value a lower number over 20 years than a really high number over 5 years. Because, if you're only at 5 years, you haven't lived through the financial crisis. You haven't lived through any real recession. I mean, until now, you're living it now. Um, and, not to say I wouldn't invest with them, but then it becomes what learning lessons have you done? Are your current deals getting burned with floating rate debt and you're still out there taking on floating rate debt? And I know it seems like rates can only go down unless you talk to people around in the 80s when they got to 18%. Like, it feels like a safe bet, but we're only at historic. When you look long-term historics back 40 years, like the treasury rates and stuff, they are basically at average now. They're not high. They feel high over the last 5 years, but they're not. And if your deals don't pencil to today's rates long-term, then you're not following basic real estate fundamentals. Like, if your going cap rate is a 4%, you're buying, or call it 5.5%. And I know some, I'm not living in the multifamily world as much today, in my active role. But it's like, that's not positive leverage. Yeah, you could buy down your floating rate loan and buy an in the money cap for millions of dollars to get down to an effective 3.75% today and make the appearance of cash flow. But if you went to market and just got a long-term fixed rate loan and let's say it came back, it's 5.75 and you bought it at 5.5 cap. And I know I'm getting into the numbers that you're like, don't dive too detailed, but that's not positive leverage. You're giving the appearance of a strong fundamental deal for the marketing speak of it, hoping that your investors don't dig deeper. But the groups that got burnt on floating rate loans 4 years ago and are working through those troubles now, I might not invest today, but I'm much more likely to invest when I see that they're taking out fixed rate loans. And to me, the defeasance and yield maintenance is worth the risk to know I have a stable expense line item, especially your biggest expense line item, which is interest.
Yeah.
If you can fix that and stabilize that, great. And, I'll say that group that I worked with right out of college, um, they were 15 years in when I joined them. When I left in 2013, they were 30. They were founded in 92, so they're 21 years into their careers as that company. And they had the founders met 20 years prior in retail, doing development and finance work in retail. They were basically allergic to floating rate debt. I have friends who worked for some large multifamily syndicators, and I'm talking the groups that your listeners may not even know of because they're so big that they barely raise any outside money anymore. The founders are billionaires and just self-fund most of their deals. From what I've heard with those guys, it's they might take a little bit of floating rate debt at a fund level, but they're basically they put long-term swaps on that floating rate debt and everything's fish. And you hear this time and time again, these groups that are 30 years into their investing careers, multifamily, retail, anything else. It's they will generally be definitely allergic to floating rate debt. And a lot of times if they have any, it's within a fund that's, okay, 3 deals out of these 50 have floating rate loans for various reasons. The rest are all locked in. Um, and so it's it's your risk profile, and like, I know this isn't a right or wrong answer. That's the problem with this business. Everybody wants like just how to do it. Here's the narrow lane and follow this path.
But that's like, Evan, I mean, part of it is, I mean, every investor is different. We all have our
Yeah.
different philosophies, but you've got to learn from it. And I think that's the biggest thing for whether you're an LP investor or an operator yourself. You have to, if you didn't learn anything from the last like year or two, you're not even trying. Like,
Oh,
you
yeah.
gotta ask better questions. You have to understand the whys and understand the business plan, the logic, the options. That's part of this. And as you're asking better questions, digging a little bit deeper, getting to that second, third, fourth level of why, then you're gonna get a sense of, how solid your business plan is or the business plan is for that property and where you may have some gaps. And I would
Yeah.
tell people, you know, I try not to get too caught up on like, do this, don't do that, or only use fixed rate or don't use that. The truth of the matter is it all comes down to the business plan.
Yeah.
And where I have thought, where I've seen a lot of issues over the last few years is the loan products did not match the business plan. And to give you an example, you're buying a brand new, kind of core plus property that's a year old. It's already 95% occupied. There's no real value add in place, yet we're putting floating rate debt on it.
Mm-hmm.
Well, why? Because you have no path to increase value. You have nothing you
Yeah.
can control there. So in that scenario, the only option for you is for the market to drive up the value, right? And that's where I think there's a misalignment versus if you had, you know, uh, I'm going to go extreme and just say a gut rehab project and say, hey, it's, it's from the studs. Well, you probably don't want fixed debt on something where you're going to create 100% of the equity or 90 whatever percent of the equity and have it tied up, right? So you've got to match the business plan to the opportunity, and then you've got to decide what conservative looks like based on that. And again, we could talk for hours
Yeah.
on this topic. For folks who do want to learn more about you, I know you've got your LinkedIn page, which we'll put a note to. If you want to learn
Yeah.
more about investing in the company, though, it's goblackgate.com. Again, goblackgate.com. That's the website. Check out Evan and his team there. Right now, we're going to transition and go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. All right, Evan, give me a failure or an apparent failure that sets you up for later success.
I'm going to say, I'm going to use somebody else's experience, and it goes back to getting laid off, where it wasn't necessarily a direct result of mine, but it definitely, that first job started in 2007, downsized in 2009. It definitely gave me a new insight as to what risks and how aggressive people get in different market conditions on these deals. And as I'm both an employee, but again, using this translates very directly, in my opinion, to LP investing as well. It is understanding the fundamentals and then the macroeconomic impacts that can change those fundamentals and what that means for either, in my direct case, my employment and salary, or in my LP world, the how successful is this investment really going to be, and how stress tested has it really been?
Yep. Give me a digital or mobile resource you recommend for our listeners.
Oh man, I'm completely blanking on this, so you're gonna have to give me a second. It's like I use it all day and it's like nothing is coming to mind. I do like LinkedIn. There's a lot of junk that you filter through, but I think there are some genuinely good insights within that world that are either very directly useful or just kind of make you think. And do that. And beyond that, my Kindle, like that. I have some physical books, and I have learned.
That's the next question. There you go. Let's get into that one then. All right. What book have you recommended or gifted the most in the last year?
I would say it's The Jolt Effect. It just happens to be sitting right here in front of me. It is kind of more of a salesy type book by Matthew Dixon and Ted McKenna, but a strong overcoming objections type read, which in today's market, particularly the capital raising world, like I said, I don't like to get too far salesy. I like to sprinkle in, well, did you think about, have you considered X, and kind of leave it at that. So it's sort of a more hands-off and let them come to their own conclusion, which it kind of hits on in that book. But it would be The Jolt Effect by Matt Dixon and Ted McKenna.
All right. Give me a daily habit that helps you stay focused on your goals.
Getting to the gym in the morning. So I go to the 6 a.m. workout class back to CrossFit World, and still get there. And then it really just comes down to that routine. With fitness specifically, it is get it out of my way, so it's not something that's grinding in my head that I have to get to before, at bedtime or whatever. But that then extends to, all right, I come home from the gym, I help get my kids' lunches ready, I make my own coffee, I get them off to school, I come home, shower, and like it kind of builds into that own routine that just kind of helps me stay, here's what's next. And you start to just get into those patterns of like your brain starts to anticipate what's coming and getting in. I feel like it gets into that mode as you're moving through your day, instead of like, all right, I need to be in deep focus. Now I need to be in, fun, free spirit, family time. And now I need to do this. And now I need to do that. It's just kind of there. And then the other one that I like, and granted I work from home primarily, is I can get out and take my dog up and down the street just to like get some fresh air, get out of the environment and kind of change the scenery, even if it's just for 5 minutes to walk to the end of the street and back. And kind of helps recenter me as well.
All right, give me your number one insight for selecting great operators to invest in.
Follow them for a while first. Get on their email lists. Have respectful calls with them. And what I mean by that is check in with them. And honestly, let them know that you're, something honest, but like you're looking to learn more, but you're not writing a check for at least 6 months kind of thing. And see how they respond to that. Because if they're willing to just spend the time with you on the front end, then in my experience, they're more willing to answer calls when things aren't going well, or you just have those questions. So, some of my biggest ones beyond all the stuff that we were talking about earlier, age, alignment of interest, etc., is, I kind of jumped in a little bit too early with a group. And I have heard that time and time again from other investors where there's like, I sort of heard about them, got a little excited about what they were doing and jumped in. And I really should have followed them for 6 months to a year and not had that FOMO of like, this looks like the best deal ever. So follow them, engage with them, see how they're doing. I have more thoughts that we could talk about for hours, but I'll stick.
No, that's great right there. Well, you're local. You're here in Cincinnati with me, man. I'm very curious of your answer to this one, but give me your favorite place to grab a bite to eat.
Was Salazar, if it was kind of date night with my wife. They have since closed, although we do love Mitas. I'd say date night, we tend to lean towards Losanti. Family night, just quick bite, North Star Cafe, which is now open in Kenwood, so closer to me.
Yeah. I like both of those options there. Great stuff there. Uh, Evan, really enjoyed our conversation. A couple things stand out. You obviously coming up with a passion for real estate, focusing more on the investor relations side, sharing both some of the insights you've learned from working in the investor relations component, talking to LP investors, and just giving us some good insights, things to look out for, right? One thing you talked about was, first of all, just understanding who you invest with. You want to make sure you are investing with someone who's got the experience. They have age, they have skin in the game, the alignment of them. How are they getting paid? What's the acquisition fee? Just really understanding, like, is there alignment? Are they looking out for us as investors, or are they looking out for themselves? There's always going to be a little bit of misalignment, but at least you want to understand that, yes, they are incentivized to perform for us and not just, getting all their money out of the gate. So really important to know, but also just to ask better questions, get to know the deal, get to know the operator, taking your time, take your time to get to know people. And from there, you can move forward. Folks that want to get to know you more, check out Evan's LinkedIn page. We'll put into the show notes, as well as you can check out the website, goblackgate.com. Evan, thanks again for being a great guest and coming on the show today. We look forward to staying in touch with you, and I hope you have a great rest of your day.